You're making $80,000 a year. On paper, that's a good salary. You did everything right. You didn't blow your money. You saved. You waited. You were responsible. Now you're finally ready to buy a house. So, naturally, you open Zillow at midnight on a random Tuesday because that's when hope goes to die. And suddenly you realize something terrifying. Every house that isn't actively collapsing into the earth costs $400,000 or more. The kitchen? Laminate countertops from 2003. The carpet? That exact shade of beige that whispers, "We gave up during the Clinton administration." The basement? Fake wood paneling, of course. And somehow, the listing agent has the confidence to call this a starter home. Meanwhile, the bank says, "Congratulations, you're approved." Your real estate agent keeps smiling like this is totally normal. Your parents won't stop asking when you're finally going to buy. So everyone agrees you're ready. Except reality. Because being approved doesn't mean you can actually afford it. It just means you're allowed to struggle. And that's the real problem. You can't actually afford any of these houses. Not really. Not in any way that doesn't turn your life into a financial horror movie for the next 10 years. And here's the truly insane part. No one involved in selling you that house has any reason to tell you this. Not the bank. Not the real estate agent. Not the industry built entirely on smiling while you sign your future away. Because as long as you can technically make the payment, they're happy. Even if it means you're one car repair away from bankruptcy. My name is Nick. Quick disclaimer before people start typing angrily in the comments. I'm not a financial advisor. This is not financial advice. This is educational content. Always talk to qualified professionals before making major financial decisions. Now that that's out of the way, today we're going to do something the real estate industry absolutely hates. We're going to calculate what house your salary actually buys you. Not what the bank says you qualify for. Not the number that looks good in a pre-approval email. What you can legitimately afford without spending the next decade eating ramen, skipping vacations, and praying your car doesn't make a weird noise. So buckle up, because we're about to start with some very uncomfortable reality. Just bought a house, so clearly it's possible. What's your problem? Why can't you figure this out? The problem is that everyone is lying to you about what affordable actually means. And I'm going to show you exactly how the math works so you can stop feeling like you're the one who's failing at something that should be possible. There's this guideline in personal finance called the 28% rule. It says you shouldn't spend more than 28% of your gross monthly income on housing costs. That's your mortgage payment, property taxes, insurance, HOA fees, all of it. 28%. The banks have a different number. They'll approve you as long as your total debt to income ratio stays under 43%. That's housing. Plus car payments, student loans, credit cards, everything. 43% of your gross income. Now, here's what nobody tells you. And this is critical. There's a massive difference between what the bank will approve and what you can actually afford without destroying your life. The bank's job is to make sure the loan doesn't default immediately. That's it. They don't care if you're miserable. They don't care if you can't afford groceries. They care that you keep making the minimum payment every month for 30 years, that 43% threshold. That's not a recommendation for comfortable living. That's the maximum amount of financial stress they think you can handle before you just stop paying entirely. Let me show you what this actually looks like with real numbers, because this is where it gets brutal. Let's say you want to buy a $400,000 house. That's actually below the national median. So we're not even talking about an expensive home here. You scrape together a 10% down payment, which is $40,000. Congratulations. That probably took you 5 to 7 years to save. Now you've got a $360,000 loan at current interest rates around 6.09% as of February 2026. Your monthly mortgage payment, just principal and interest, is about $2,150. But wait, we are not done. Not even close. Now add property taxes. Depending on where you live, you're looking at anywhere from $300 to $650 per month. Let's call it $450 to be conservative. Then there's homeowners insurance, thanks to climate change making everything more expensive to insure. And we'll get into this later. You're probably paying $250 to $350 per month. We'll say $300. Oh, and because you didn't put 20% down, you've got PMI, private mortgage, insurance. That's the fee you pay every month for the crime of not being wealthy enough. In San Francisco, $500,000 gets you a 600 square foot studio condo. You'll probably have roommates. The HOA fee will be $500 a month. You'll share a wall with someone who plays the drums at 2 a.m. In Los Angeles, you might get a one bedroom in Koreatown. Not Beverly Hills, not Santa Monica, Koreatown. In Austin, $500,000 creates a choice. You can have a downtown one bedroom condo, or you can drive 20 minutes outside the city and get a brand new 5-bedroom house with a yard. In Atlanta, $500,000 gets you a 4-bedroom house in a good school district with hardwood floors and a 2-car garage. In Cleveland, $500,000 is straight up luxury. You're getting a 4,000 square foot historic home with a massive yard in one of the best neighborhoods. The income required to buy a median home in San Jose is $501,760. In Cleveland, it's $63,611. That's an 8 times difference within the same country. The housing market isn't broken uniformly. It's broken in completely different ways depending on your zip code. And this brings us to the part that makes this truly infuriating. Your parents bought a house at your age. They keep reminding you of this. What they're not telling you, because they don't understand it themselves, is that they bought a house in a completely different economic universe. In 1980, the median home price was about 3 times the median household income. Today, it's 5 times. Your parents were buying houses that cost 3 years of their salary. You're being asked to buy houses that cost 5 years of yours. But wait, you say, didn't they have crazy high interest rates? Yes. Mortgage rates in 1980 were around 13%, peaking at over 18% in 1981. Monthly payments were brutal. But here's the thing, the purchase price was reachable. They could actually save the down payment in a few years instead of a decade and more. Importantly, when rates dropped, they could refinance. You can't refinance the purchase price also, and this is critical. College costs $738 per year in 1980. Your parents weren't graduating with $40,000 in student loans. The average new car payment in 1980 was about $153. Today, it's $748. They bought houses on single incomes because one parent staying home was financially viable. Today, you need 2 incomes just to qualify for the mortgage, and even then you're stretched. Baby boomers currently represent 42% of all home buyers, and half of them are paying cash. Meanwhile, first-time buyers have dropped to just 21% of purchases, a record low. The median age of a first-time buyer has risen from 28 inches, 1,991 to 40 inches, 2,025. Think about that. The average American is now 40 years old before they can afford to buy their first home. And increasingly, they're doing it with help. 7% of first-time buyers now use an inheritance for their down payment. Family wealth is becoming a prerequisite for home ownership. Now let's talk about all the costs nobody mentions until after you've bought the house, because this is where the real pain starts. The mortgage payment is just the beginning. Recent studies show average hidden annual costs hit $21,400. That's $1,783 per month for maintenance, utilities,